In regards to the economy, which is really driven by both politics and finance, if you want to know what's going on there, you kind of have to look at Jerome Powell, the head of the Federal Reserve. The Federal Reserve sets the monetary policy, not just for the United States, but really for the whole world, by setting the price of money. Right? So when they increase interest rates, like they've done, the fastest rate in history, then they're changing the price of money. They're making money more expensive. When money's more expensive, less people buy it. You buy money by paying the interest rate. Now, the Fed just had their annual meeting in Jackson Hole, Wyoming, where it wasn't just the U.S. and the Fed. It was the international bankers as well. Christine Lagarde from the ECB, European Central Bank, was over there, as lots of other bankers were as well. Now, of course, since it's in the U.S. and it's the Jerome Powell and the Fed's meeting, of course, Mr. Powell gave his keynote address. Now, a couple of things of interest in there was that he said that the fight against inflation wasn't finished and that there was still a long way to go to get the job done, which seems kind of hawkish. He said that the lower monthly readings for core inflation in June and July were welcome, so he liked it. But, he said, 2 months of good data are only the beginning. 12-month core inflation data is still elevated. So he's kind of saying, look, we're committed to bringing down inflation. He said this many times. He said there's going to be pain. He said we have to get back to 2%. He said, sure, we've seen some trends going down, but we're not content with that yet. So he said that, quote, we see the current stance of our policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we can't identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint, end quote. Kind of cryptic. Let me break that quote down for you a little bit. So first of all, he said that we see that the current stance of policy as restrictive. So that's his policy. So the policy he's enacting is restrictive. He says, quote, we see it as restrictive, putting downward pressure on economic activity, hiring, and inflation. So we see current stance of policy, his policy that he's enacted, being restrictive and putting down pressure on the economy, hiring, and inflation. So, downward pressure on economic activity. Do you own a business? Well, he is purposely trying to make it hard for your business. He's trying to push down economic activity. He doesn't want your business to have as many consumers or customers. That's his goal. He says that it has downward pressure on hiring. So unemployment. They want unemployment to go up. They want less people working. Think about that. What he's saying. Our current stance of policy, the policy that I, as the Fed chair, have put in place, is trying to slow economic activity and hiring down. We don't want you to have a job. Your job making more money is a problem for us. It goes against what I'm trying to do because I'm trying to bring inflation down to 2%. And in order to do that, I need less people working. And I need more people making less money. How's that? Well, the good thing for Jerome Powell is he doesn't get voted in. We don't vote for him. Imagine people voting for someone who's literally trying to destroy their businesses and their livelihood. Pretty interesting. And then he goes on to say, we can't identify with certainty the neutral rate of interest, and thus there's always uncertainty about the precise level of monetary policy restraint. We can't identify the certainty. Well, there is no such thing as certain. Certainly, you can't control the certainty of the outcome of the financial system. To think that you can just show you that you're an idiot. But what he said is that the precise level or the neutral rate of interest. So they're changing, again, the price of money. That's the interest rate. Trying to find the neutral rate of interest. What the heck is the neutral rate of interest? Well, they can't define it with any certainty, but what they're trying to define is the rate, is it 4%, 5%, 2%, 3%, the rate at which monetary policy is neither contradictory nor expansionary. So when interest rates get low, the price of money, the rate of interest goes low, money's cheap, so lots of people borrow it. So it expands. Expansionary is the word you used. But if it's expensive, then less people use it, and then it's contradictory. Contractory. right? Not contradiction, contracting, contractary. So if money is expensive, then I don't open up that new office. I don't hire more people. I don't bring on new trucks. I don't service new clients because the money's too expensive for me to do that. So that's contracting the economy. But if money's too cheap, then I expand. Now, I would argue that the market's always doing both. And for them, to his point, we cannot identify with certainty the neutral rate of interest. Well, of course you can't. Because you don't understand, you don't have enough information. It's not just Jerome Powell. Anybody who thought they could do that would be out of their mind. You don't have enough information to manage 330 million people in the United States, 8 billion people in the world, and all their changing wants, needs, and desires. That's why the price of money is not supposed to be set. The price of money is set in the free market. You see, the way it works is that if I want to open up a new office and I want to get new trucks so I can service more customers and I have to go borrow money, I need to know how much that money is going to cost me. If it's too expensive, I don't take it. If it's too cheap, I do, right? But the problem is when that's not found in the free market. So the way it works is that if a lot of people have a lot of savings, then that money is cheap. We have more people with savings, more people trying to lend me money. So there's less people borrowing, more people trying to lend, the price of that money goes down. When that money goes cheap, it tells me a lot about the economy. It tells me that there's customers out there that have money. So I borrow the money at this cheap rate because I know it's cheap and I know the economy's good. Now, the flip side is if there's a lot of people wanting to borrow and not very many savers and lenders, then the price of the money goes very expensive. And that tells me that maybe I shouldn't take on that loan because the economy is probably bad because there's not a lot of extra money in the system. So the price of money is supposed to change. Oh, you mean, Mark, like all other prices on supply and demand? Yes, on supply and demand. But somehow, magically, Jerome Powell is trying to come up with the rate of interest, the neutral rate of interest, but he can't, per his own quotes. So he's prepared, he says, quote, "We're prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we're confident that inflation is moving sustainably down toward our objective. But even then," he said, "we'll proceed carefully with future rate hikes." So basically, it's a bunch of wishy-washy back and forth. We're paused. We see some good signs, but we're not sure if we're out of the woods yet. So we're going to kind of wait and see. So in my opinion, if you want me to interpret this Fed speak, that's what we call it, Fed speak to you, he's playing both sides, leaving his options open. But in my opinion, he's setting the stage for no more hikes and saying that we might only have one or two more and we'll be done.